right, welcome back to another Kahoot game. Today we will be doing Life and General Health Quiz 1. So let's get started. Okay, question 1. Both the company and the customer must bring something valuable to the other party for the contract to exist. It is called...
I guess I do know it.
Consideration. Yes. So every time you see the word something valuable, think consideration. They are both considering each other to see what value they bring to each other in this contract. So consideration, valuable.
What?
What does adhesion mean in insurance terms? Adhesion. So think about sticking adhesive spray or adhesive tape. You're sticking to what the insurer says. You're going to take it or leave it. So adhesion, think adhesive, sticking together, sticking to what the insurer says. Okay. Question 3. What does the certificate of authority allow an insurance company to be? Admitted. So when we think about the certificate of authority, insurance companies are admitted. Agents are appointed. And so, of course, domestic just means you're licensed in one state, you can sell in that same state. We know insurance companies aren't licensed. They're not necessarily certified. They're just getting a certificate, but they have to be admitted. So a certificate of authority allows an insurance company to be admitted. That's almost like their appointment. Question 4. Jay purchased life insurance 5 years ago and received a tax-free dividend last year. Which type of insurer did she buy it from? Mutual. So with mutual companies, they allow their policyholders to participate. So because they're participating, they're going to get something in return. And most of the time they receive dividends. So when you think about mutual, they're sharing, the policy owner is getting something out of it. So they're going to get that dividend. So when you see dividend, think mutual. They're sharing, they get something out of it. What does the law of large numbers state? Yes, the more data, the more predictable actual losses will be. So when we think about the law of large numbers, think about statistics. You need a lot of data, which means you need a lot of numbers. And when you have a lot of numbers, it allows it to be easier to predict what will happen. So you need more data in order for it to be more predictable. So that is the law of large numbers. All right, question 6. What is fiduciary responsibility? The agent submits premiums collected to the insurance company. So when we think about fiduciary, think about trusting, or you have a responsibility that the insurance company has you to do, which is submit premiums. And that's a big deal. They have to trust you a lot in order to collect somebody's premiums. So that's fiduciary responsibility.
I just cannot catch up to Bailey Ann.
I know Bailey been studying.
Ready.
Question 7. What is insurance known as? Yes, transferring risk. Good job, everybody. Anytime you see insurance, it's all about transferring risk between the insurance company and the insured. Question 8. Which type of life policy is the most cost-effective way to protect a new home in the event of a spouse's death? Yes, decreasing term is the most cost-effective way. This is mortgage protection insurance. So just in case something happens, the term will decrease over time, so you'll have a little bit left to pay at the end. Hey, Bailey, got that streak. Question 9. What is the main difference between individual and group insurance policies?
I didn't get the answer.
Yes, group policy allows coverage for individuals without underwriting. If you work a job, most of the time they'll offer you health and life insurance, and that's all you have to do is just sign up for it. They don't have to do any extra medical exams or nothing like that. So that's the main difference between the two. All right, question 10. Which of the following is an example of a limited pay life policy? Life paid up at age 65. So when you think about a limited pay life paid up to the age 65, you're done paying anything at age 65. So it's very limited. You've already paid everything. An endowment is not necessarily a type of limited pay life policy. That's more of a contract. But life paid up at age 65, you're done paying. So it's very limited.
And one moment before you move to the next question, Bailey has something in chat. So I remember with group that the insurers don't have to have a medical exam. With group insurance, it's figured out on a ratio, of men and women. So good point. That is true. Endowment, does endowment always mean MEC? So, and with that, no. So with the, let me say yes and no, right? Because, and the reason why I say yes and no, with the MEC itself, what that is that, it's that scale or that table of payments. Like say, for instance, if you have a life insurance policy and you want to make multiple premiums that will be over what your normal monthly, premium would be, in order to stay in within tax compliance, right? The MEC is put there to make sure that you have made at least 7 payments, right, towards that policy. You have to have at least 7, what they would call annual. They call it the 7 pay table or 7 pay rule. Do y'all remember what I'm talking about? Yep. The number of 7. Yeah, exactly. So that's when they're talking about the MEC, that's what they're speaking about. So it is endowments, meaning those payments that you put in, the endowments that you put in. But most times, like when it comes down to an endowment, like what was pointed out on the previous question, that was a pay out to the person that had that contract or annuity. That's that endowment, right? So that's the difference between the two. That's why I said it's a yes and a no. You know what I mean? But you have to have those 7 payments in order to stay in tax compliance when it comes down to, like different policies. Because some people, what they had come to learn was that there was some people that were getting life insurance policies not to make sure that their end of life expenses were taken care of, but they were actually using them as financial tools, to get rich off of. Make a few payments on it, hurry up and pay a lot of money into it so that cash value will build up even faster, and then they will have more cash value. Then they would just cash in on the policy to get that cash value. When they started discovering that that's what was happening, that's when they came up with the MEC to say, no, you're going to have to make at least, 7 payments. They're going to have to be, worth the premiums that we initially assigned to this policy. And in that table, if you go by those rules and you make those at least 7 payments, then you're obviously not using it as a financial tool.
Right.
Because by the time you've made, at least by that last 7 payments, you've actually paid into it what you would have gotten out of it had you cashed in, if you cashed the policy in. So that's why they put that into place. So you can't use it just to get rich off. They want you to use it for what it's supposed to be for. So, all right, okay, I'm done with my rant.
Okay, question 11. What's an insurance policy that requires a single lump sum premium payment at inception and endows when insured 100? Yes, a single premium whole life. And the answer is in the question. Single lump sum premium. And of course, whole life ends at about 100 when they pay you out if you live that long. So single premium whole life.
Yep, you're right. Looking for keywords. Yep. Because there are going to be some words in the question that'll help you answer it. So, yep, good deal.
Question 12. Which type of whole life insurance policy allows policyholders to flip between term and whole life? Yes, adjustable life. They can adjust or flip it between term and whole life. So, adjustable life. Sorry, y'all. My child trying to swallow a paper towel. Lord.
Come on.
Oh, Lord. Okay. Question 13. What is the purpose of a juvenile life policy? Yes, begin a life insurance program for a child at an inexpensive rate. So a key word here is juvenile. That is a young child or person. Not all these answer choices, that's the one that involves a child. So juvenile life policy. Question 14. What is the main difference between type A and type B universal life insurance policies? Type B has insurance on top of cash value, while type A does not. So in universal life insurance policies, they're basically life insurance policies that revolve around flexible payments or flexible death benefits that you can change over time. That's why most of the time they cater to younger people. So type A is just the basics. You don't have a cash value with it necessarily. But type B, that's a step above. You have cash value on top of the insurance. So yeah, type B has insurance on top of cash value, while type A does not. So that's the main difference between the two. So just think about type B being a step above type A. Get a little extra.
We got something else in chat. 1 second. Sorry. Says that and some of the juvenile and family income are very inexpensive. True. I remember that with juvenile, or maybe it's the child rider that lets the policy owner have one policy for all the kids. So yeah, it's actually the child rider. So what that means is like a parent can start, say if the parent starts a life insurance policy for themselves, and then they can add a child rider, meaning they would add additional coverage for each of the children in the household or in the family as well, and that would be very, very inexpensive for the parent, of course. And then with the child, the only thing with the child rider, once they turn 26, then the child is going to need to get their own policy. So it's a good and a bad to the rider, right? At least, they will have that coverage added onto their parents' policy until they become what in the insurance world is considered an adult. But then as an adult, they'll have to get their own policy. Whereas if you get them a juvenile policy all on their own, that policy will remain intact even after 26, and the premium doesn't change for them. You see what I mean? So that's the good and the bad, or the pro and the con of a juvenile policy versus just having a child right. Eventually the child's going to have to get their own. With a juvenile, they won't. Mm-hmm. Then it says, and for A and B of universal life, I remember something about one is level and one is decreasing. What's your thoughts on that one, Michaela?
Well, just as far as I read, I just know the main difference is B, you'll have cash value over A. I don't know, you might be talking about, well, it might be increasing, but I didn't read that because I was reading it this morning. But
no, she said decreasing. So with B, because with B you get a guaranteed, you got guaranteed cash value with B. So, and A, the reason why there isn't guaranteed cash value, or the reason why there isn't cash value with it, is because because it's decreasing. That's why. Right? Because there is no cash value that's able to accumulate over the term of the policy with A. Whereas B, because it stays, the cash value can accumulate as you continue to make your premiums, and then plus, it gains interest with each premium payment. So that's why B is able to guarantee a cash value, because it stays level the entire time. You're paying the same amount the entire time. With A, because your premiums are decreasing, it doesn't have the option to build that cash value.
Yeah, that makes sense.
Why can I not on the actual state exam? Well, because, and here's the thing, and that's what I think a lot of us suffer from. Like, a lot of us can have a conversation about this material, right? Once we learn the content. And I think, to be totally honest, because I go through the same thing, Bailey, right? When we sit down to take an exam, it adds a layer of pressure.
It does.
Like, you know what I mean? It really does. It just adds a layer of pressure. And then you're thinking about, although if you ask me, they give us plenty of time to take the exam. But the fact that you're thinking about your being time, it gives us anxiety.
It does.
So don't feel bad, because a lot of us go through that. Like, I know you haven't heard my test taking story, but girl, it's a mess. Like, I literally sweated through my clothes. Seriously. Like, I don't know how I didn't catch pneumonia. Because it was definitely cold, out, and I was sweating like, we were in the middle of the summer. So by the time I got up from that chair, like I could feel it on the back of my shirt, like I had sweated through my clothes. And it was just and I really did feel like I was as prepared as I was going to be to take the exam, right? But it was the fact that I was taking an exam. Yeah. Like, that was stressful. That was stressful. A lot of us go through that, believe me.
And that's why you really have to trust your brain that it knows the information. That's why a lot of times when you read questions, you'll already know the answer before you even see the rest of the answer choices. And oftentimes we'll trick ourselves and be like, okay, that's too easy, or no, that can't be right because I thought about it too fast. No, your brain already has memorized what you study. It knows the information. You just have to trust yourself when you get in there and just block out the extra pressure and be like, okay, look, I know what I'm here for. Let me focus, take my time, read the questions, but I know the answer already. Because like I said, Bailey, you've been studying for I don't know how long, so you know the answer and you know how to spit out the information back. Because I've heard you do it when we were, had our first Kahoot with each other. So you know it. It's just, you just have to trust yourself and just breathe.
Yeah.
Look, I got plenty of time for this. There's no rush. I know the answers, you know? So don't worry about it too much.
Yeah, it's human nature. We know that it's human nature because we've all been through. That's one thing about it.
Yeah.
We have all been through it, and it's human nature to, number one, second guess yourself.
Exactly.
You know, and that's something that we just have to learn to stop doing. And I know sometimes that's easier said than done. But I think that's the biggest thing when it comes down to, you know, all of us, because we've all done it. Believe me, we've all been there, done that. So it's really about, like Michaela said, going in and just trusting that, because you know it, you know. Yep. And then at the same time, being that you know it, try not to stress yourself out so much or worry about any previous attempts that you've tried the exam. If that's in the past, let it go. Don't worry about it. You know what I mean? Because you got enough pressure on you. You're taking an exam. That's enough. You know what I mean? Let the other stuff roll off your back, and you'll be fine. Because you definitely know the material. So
exactly. Yes, the death benefit remains constant over time. That keyword, traditional whole life policy, which means, of course, it's constant, it's fixed, it doesn't change over time. Which policy allows the beneficiary to collect both the death benefit and cash value upon the insured's death? It's universal life, option B. Like we just said, option B has that additional cash value on top of it. So if the beneficiary is able to collect the insured's universal life policy. Hey, Billy, you got streak of 16. Question 17. What type of life insurance provides an investment component alongside the insurance coverage? Yes, index variable life. So when you see that word investment, think about index funds, equity indexed variable life. See, they may trick you with universal life, but see, they just said universal life. So you would assume it's part A or type A, which doesn't accrue cash value. So the only one that would in this instance would be the indexed variable life policy. All right, question 18. Which type of life insurance allows the policyholder to skip premium payments? Universal life. So universal life gives you the opportunity to have flexible premium payments, so you can kind of determine when you want to pay or how much you want to pay over time. You can change it compared to the rest of these. Of course, whole life is constant. Index life, if you want some type of cash value, you can't skip premium payments. Limited pay whole life, you only have a limited amount of time, so you can't skip the payments. So universal life is all about that flexibility with skipping premiums or skipping, to determine different death benefits. So universal life.
See, Bailey, I just second guessed myself, and guess what? Guessed it wrong. The second time I chose was the wrong one. And I just told you, don't second guess yourself. So it's human nature. We do it all the time.
It is. Question 19. What is the premium characteristic of an annually renewable term policy? Yes, C, renews each year with an increased premium. So annually renewable, renews every year, and term policy. Every time you renew, they have to go based on your age and your health. So you will have an increase in your premium. So yes, renews each year with an increased premium. Question 20. In a limited pay life paid up at 65 insurance policy, when does the policy mature? At age 100. So in a limited pay life paid up, you're just paying up to the age of 65. That way you won't have to make any more payments in your policy just in case something were to happen. So it's still a whole life policy, which we know doesn't mature until 100 if you live that long before they pay out. So limited pay life just meaning you're paying up until you get to the age of 65. All right.
Ooh, Bailey is beating the back.
Question 21. Annuities are classified by method of payment. So when it comes to annuities, are you going to have a fixed annuity, a deferred annuity, an equity index annuity? So what method of payment are you going to use with annuities? So they are classified by the method of payments.
Yeah, but the annuities are really hard for a lot of people, myself included. I struggled with annuities as well. To be totally honest, I didn't start learning or really grasping annuities until we started the study hall, and I had been licensed for years by then. It was me having to go back and study up to help others. Because to be totally honest, when it came down to annuities, I did not learn them by the time I took the exam. I made sure I knew everything else. So when I got to an annuity question, I just chose C and kept it moving because it was not about to stress me out. I just could not get it. So annuities are a stickler for a lot of people. I mean, a lot. So, and thank goodness though, on the exam, there's not a lot of questions about annuities.
Exactly.
But yeah, And it's funny because the content with annuities, even for me, when we started the study hall, was a little harder for me to figure out how to break it down to others for it to stick, as well. Because like I said, I struggle with it as well. So a lot of us do.
Yeah, because I really didn't start understanding it either until I started teaching it. I'm like, okay, let me figure out how to explain this to somebody.
Yeah.
But at least with annuities, most of the time, they're just going to ask you the questions on the phases, annuitant or annuitization, accumulation period, so you don't have to know too in depth about annuity.
Right. Thank goodness.
I know. Question 22. Which of the following statements is untrue about fixed annuities? Their monthly payout amount can vary. So the key word is fixed. So with fixed annuities, it's going to be constant or level. So that means their monthly payout can't vary. It can't be all over the place. It has to be leveled or fixed. You will get an interest rate return on them. You will have a general account with an annuity. And then, of course, the carrier assumes interest rate risk in case something happens. So look for those keywords, untrue about fixed annuities.
Yep, and I answered it wrong because I didn't look at the right word. Oh, goodness. It said untrue. I'm thinking true. I'm so mad at myself. So, Bailey, look, just so you know, and I'm quite sure you already experienced this, reading the question, okay, and making sure you're reading the right words in the question matters too. Because I just answered it wrong, knowing I knew what the answer was, but I'm thinking which statements is true, not untrue, and they do that to us on purpose. They will word things funny, just to see really how much attention you're paying.
Exactly.
And that's just a part of their, trying to trip you up on stuff. Just like they ask you the same question over and over on the exam, they just word it differently. That's just another way of tripping you up or making you second guess yourself. So. Exactly.
Yes. Question 23. All of the following are true about annuities except so they are used to eliminate paying taxes in retirement years. So all the rest of the statements are true except, see, in retirement years, you can't eliminate paying taxes because once you start withdrawing that money, you will be taxed on it. So you can't eliminate paying taxes. You're still going to have to pay the taxes. So everything else is true. You're sheltering the money to avoid paying taxes at the beginning, you know, just like a 401k or Roth IRA account. You're just putting money in there for now, for it to grow later. But over time, in retirement, once you start taking that money out, you're going to have to pay for it. So keyword, you can't eliminate paying taxes. So that is not true.
And then Betty got something else in chat. Said with annuities, I remember interest is taxable, but not the principal. Mm-hmm. So yeah, and that's true. And the reason being, the reason why the interest is taxable is because the interest was earned, right? It was or accumulated from the money that you put in. So the way I learned how to break this down to some people as well, think about how you funded that account or that policy or that annuity. If you funded it with your money from work, it was already taxed. So you won't be double taxed, right? That's the principal part of it. The interest, which is what was gained on what you paid into it, right? You didn't pay taxes on that. So that's why when you get the interest funds, then yes, you're gonna have to pay taxes on it, right? So always think of how was it funded. If you use tax dollars to fund it, then you won't have to pay taxes on it later because you've already paid taxes on that money. You know what I mean? Taxes were already taken out from the funds that you used to fund that annuity or what have you. Right. But the interest, you didn't pay anything into it. It grew on its own. It was gained. So you're going to have to pay taxes on it. Mm-hmm. Hopefully that clears it up a little bit. I
don't know. Question 24. An annuity that guarantees a minimum rate of return is called fixed. So if anything is fixed or level or constant, you're guaranteed that you're going to get something, a minimum rate of return, the bare minimum at least, because it's fixed. It's not going to change anything. So because of that, you're guaranteed.
I keep losing connection.
Oh.
Yeah, mine just flashed up, but then it came right back. So hopefully.
I know.
I didn't even get down to that question because I didn't see it. So.
Oh.
I don't know.
Acting a fool again.
Yeah, because mine said it too. What about you, Bailey? Did you get the same message? Latoya, you said that your bandwidth is low. That's what came up like when you was trying to talk. Okay, good. Bailey didn't have that issue at all. And mine flashed and said that it was a connection issue, but then it came right back, thank goodness. So mine is back.
Okay, let me see if it'll let me go past this question.
Maybe it's working.
I know. Question 25. An annuities may be purchased with all of the following payment methods except.
Oh God.
Yes.
Ran out of time.
So maybe purchased with all of the following payment methods. So when we look at these answer choices, a single lump sum, yes, you can have a single premium annuity. A period of fixed payments. We just talked about fixed annuities, so you can have fixed payments. A period of flexible payments. You can have a variable annuity. So sporadic payments until age 50 is the only one that doesn't make sense because you're not just going to randomly make payments until you're 50. So that doesn't make sense. So right. Yes, annuities can be purchased with all the other three. Question 26. An annuity begins paying a month after it is purchased. What type is it? Yes, single premium immediate annuity. So keywords, it begins paying out, which means it's already paying out immediately after it is purchased. You just purchased it, so all you needed was that one-time premium, and it immediately paid out. So single premium immediate annuity. All right, Bailey got that streak of 26.
Yeah. Great.
Bailey ain't missing.
No.
Question 27. Which type of annuity settlement stops when the annuitant dies? Yes, a life annuity. Just like a whole life policy, once the annuitant dies, the settlement is going to stop. A life annuity. Question 28. An annuity which pays a specified period of time, whether the annuitant is alive or dead, is known as a... Yes, period certain annuity. Keyword, specified period of time. Specific period of time. Period certain annuity. Question 29. If an annuitant withdraws cash before age 59 and a half, the tax penalty is 10%. Just a little bit. You're going to get penalized. 10%. You just have to kind of remember that one. Question 30. The minimum rate of return an annuity earns in a fixed annuity is determined by guaranteed interest rate.
One too fast.
With a fixed annuity, you're going to at least be guaranteed the minimum rate of return. So it's guaranteed interest rate. Think about fixed annuity. It's guaranteed that you're going to get something.
Right. And it doesn't go by the current interest rate, because that could,
right.
To be totally honest, that can change over time as well, right? You got an annuity for a long period of time.
Right.
And so with it being fixed, that's why they have to go by, they're going to say at the beginning, 3% interest rate. And that's what it's going to be regardless. Sometimes it may gain 8, sometimes it may only gain 2, but they have guaranteed you that 3% no matter what's going on. Mm-hmm. So that's why they can't go by, current interest rate, because, like I said, that will fluctuate. So that wouldn't be a fix. If it's fixed, it's there, it's in place, it's set, it won't change.
Exactly. Question 31. What is the term used for the period during which an annuitant contributes to an annuity? Yes, the accumulation period. So as you're putting money into that annuity, it is accumulating, it's growing. So the accumulation period, letting that money accumulate. Question 32. When you say years to put money into an annuity, it's called a... Yes, a periodic premium annuity. You're taking years to put money in there. So every so often, periodically, you're putting money into that annuity. So periodic. It's taking you forever to put money into that annuity. Question 33. When you switch from putting money into taking it out of the annuity, you call that... Yes, annuitization. So you switch from accumulating that money. Now you're taking it out. It's yours now. So it is annuitizing, or the process of annuitization. You're able to take it out.
Let me hold on. And I know that one right there, it trips people up too. Good job, Bailey. You got it right. I'm so glad.
Yes.
So, and the reason why, because see, that used to trip me up. These terms right here, the annuitant, annuitization, accumulation, and then payout. And you like, well, hold on, because it said you're taking the money out, right? So you like, automatically, you're going to think payout. But what the question is asking you is that that simple action of switching. So they're not talking about, you actually getting the money. That's the payout. They're talking about the action of going from funding it to now I'm about to start taking it out. That's where that comes from. So it's not the payout, because they're not talking about when you're getting the money. They're asking you about the switch. What's the switch called? So just to clarify a little bit.
Okay, question 34. Which statement best describes annuities?
They're hard.
Yes, it is the opposite of life insurance. So annuities, basically you're funding it just in case you live too long. You need some type of income when you're old and retired. That's the purpose of doing an annuity in the first place. You want some money when you retire. So instead of dying too soon, you're expecting to live too long. And see, the rest of these answer choices don't really make sense because it's not designed to just protect mortgages. It doesn't involve the stock market necessarily, or is necessarily designed to provide funds for college education, even though you can use that money for that. But it is the opposite of life insurance. You're just expecting to live too long. You want to make sure when you get old, you have some money.
Yeah. Life insurance is if you, like I said, if you pass away, or when you pass away, or maybe you pass away before retirement or what have you, that takes care of, and it's supposed to take care of not just, funeral, but end of life expenses, any debts you may leave behind. Whereas, and you're right, Bailey, with what you put in chat, your annuity, it's the opposite of life insurance. It means that you outlive your money. You don't want to outlive your money. So that's why you put something in place so that even when you retire, because most of us, of course, when we retire, we lose part of the income that was coming in on a regular basis when we were working. So you have an annuity set. That way, when you retire, you can continue to live the same way you were living when you were, going out there and working every day. So, yeah, that's exactly it. To help out after retirement. That's what it's supposed to be.
Okay, question 35. The benefits from a business overhead expense insurance policy are limited to covered expenses and are taxable to the business. So business overhead expense, keyword business expenses, we're just focusing on the business. So with that insurance policy, it's only limited to cover a certain amount of expenses, just like may cover payroll or for a key employee, just a certain amount of expenses, not everything, and are taxable to the business. So the business can write this off. We're not talking about the business owner. See, all these dealing with business owners. We're not talking about the owner, we're talking about the business itself. And it's not received tax-free. It is taxable to the business. So business overhead expense, limited to expenses, and are taxable to the business. All right, Bailey still got it right.
Bailey is killing it.
Question 36. Which of the following terms relate to disability income insurance? Yes, residual benefit. So when you're disabled, you're not working at the time. So they're making sure you at least receive some type of benefit. So you're just getting a little bit of that residual income that you're missing out on if you were working. So residual benefit. Bailey, you ain't even studied health insurance yet.
Oh, she just put in chat. She has a personal experience with that, so that's why she knows that. Yep. But hey, life experiences help us too on this test. Honey.
Exactly. Okay, question 37. Upon payment of a loss, the insured is obligated to surrender to the insurer the right to sue a negligent third party. This is called...
Oh, I didn't. Thank you, Jesus.
Subrogation. So when we think about this, we have to think about if you were in a car accident. So the insured was in a car accident. A third party hit them, totaled the car. So the insured had a loss. They're going to tell the insurer or the insurance company about it. The insurer is going to pay for that loss. But that insurer is going to keyword sub. So they're going to sub in or substitute for the insured. And now they're going to sue that person that crashed the car. They want their money back. So the insured is getting their money from the insurance company. Now the insurance company wants their money. So they're subbing in or subrogating, substituting, just keyword sub, so that they can get their money back. Right, y'all. Question 38. What is an agent guilty of if they offer a cash reward to a prospect in order to buy a policy? Yes, rebating. When we think about rebating, think about reward. They're trying to pay somebody to buy a policy. Rebating. Question 39. What is the term used for insurance sold by agents only to family members, relatives, and employees? Yes, controlled business. The agents are trying to control their business by keeping it closed only to family members and people they know. Controlled business. Okay, question 40. Which organization safeguards the insured against the financial failure of an insurance company? Yes, Life, Accident, Health, and Hospital Guarantee Association. So this association is covering life, accident, health, hospital, just about all the life insurance policy types or insurance company types. Somebody's sleeping.
Did you, Bailey? Hold on. She said she guessed at that one. But yeah, so, and let me tell you what probably or may have thrown you off, and it's because usually they're just called, what are they called? Insurance Guarantee Association.
Yeah.
So it may have been those extra words in there, right? But sometimes they spell it out just that way, and sometimes they just call it the Insurance Guarantee Association. Either way, that they put it, that is the association that takes care of an insurance company's responsibilities. Say, for instance, if they were to, what they call it, insolvent, they become insolvent, and then they have claims out there. The Guarantee Association is going to, make sure that those claims are paid. They sometimes help insurance companies to make sure they don't become insolvent, so they can, uphold their responsibilities, things like that. So just be careful because sometimes they just put a lot of extra words in there too as fluff to throw you off. But if you see Guarantee Association, that's the association that helps insurance companies, to make sure that they can uphold their responsibilities, like when it comes to, filing claims and paying out claims or, and things like that.
Exactly. Okay, question 41. Which statement is not covered by the Fair Crediting Reporting Act? Yes, the notification of the applicant must be separate from the application. That is not covered by the Fair Credit Reporting Act. So the Fair Credit Reporting Act, they're just responsible for reporting information. So if it's incorrect, they're going to update it and correct it. They have to be notified notify the applicant in writing what's going on, and the applicant can question them, the validity and source of the information. So the notification of the applicant must be separate from the application is the only one that is not correct. Question 42. Who is a certificate of authority issued by the insurance commissioner intended for? Insurance companies and agents. So it's for both. Both of them can be issued by the insurance commissioner. So both.
I didn't read all the answers for you. Oh, God.
Question 43. Which action does not result in the denial, revocation, or suspension of an agent's license? Lack of competence. This is the only one that they won't revoke or deny or suspend an agent's license for. So, of course, if you do something willfully violating an insurance law, most likely committing a fraud or something, you know you're going to get your license suspended. Soliciting insurance, material misrepresentations, or messing up on applications and stuff can get you in trouble. So the lack of competence is the only one that you won't lose your agent's license for. Okay. Question 44. For which reason can an application for a license not be denied? Yes, the applicant does not have a college degree. They can't deny you a license just because you don't have a college degree. Because there are a lot of agents that don't have a college degree. And the rest of these, of course, if you do something wrong, they're not going to give you a license. So you do not have to have a college degree.
Jesus.
Question 45. Agent provides false statements about policy benefits to a proposed client during a sale. What offense is committed? Twisting. So with twisting, you're basically trying to turn the story or make up something to make it sound good so that you can convince a client during a sale. Now, with coercion, that doesn't necessarily mean you're telling false statements. You're just trying to convince them to buy the policy. But see, with twisting, you're making those false statements and you're trying to turn it or lying to convince them to buy the policy. So you're twisting, making up stories.
Yep, I always remember that one by saying you're twisting the truth. You're telling a lie, you're twisting the truth. So yeah,
twisting the truth. I like that one. Question 46. Which of the following is not considered an unfair claims practice? Okay, so settling a claim for the benefit amount stated in the policy, that's only fair. See, the question asks which is not considered an unfair. The rest of these are unfair. If you refuse to pay a claim, that's not fair. Settling claims for less than the reasonable amount, that's unfair. Misrepresenting facts, that's unfair. But settling a claim for what was stated in the policy, that's only right and only fair. All right, Bailey just.
Ooh, wait. No way, I'm gonna catch up.
It's up there. Question 47. In order for an agent to renew their license, they must. Yes, we all as agents have to take continuing education every couple of years and pay our state license fees. Good job. Question 48. A commissioner or director can either be blank or blank. Yes, elected or appointed. And they may try to mess you up by saying admitted. Admitted is for insurance companies. We're talking about the commissioner or the director. So they have to be elected by the governor or appointed by the governor.
And 1 second. So yeah, and that may be true, Bailey, because she was asked, she said she thinks with certain type of CE, like with annuities, in Kentucky, and I would think this would actually be in all states, honestly. You have to have an additional 3 to 4 hours of extra CE. I would think that is true, Bailey, when it comes down to annuities. And like I said, I think that's across the board, no matter what state you're in as well. The thing about that, and the reason why I'm saying that is because, you have to have a totally different license in order to sell annuities. It's a securities license. And with everything you have to go through in order to get that license, I would think that, yes, they do have some additional CE that they would have to complete as well. See, like with us as agents, without that securities license, it's 24 hours regardless, 24 hours every 2 years regardless. But yeah, I would think if you have a securities license, yeah, you're going to have more than just those 24. But that's a totally different license altogether. So yeah.
All right. Okay, question 49. Which of the options below does not fall under the purpose of a commissioner?
What in the world?
Yes, setting insurance rates. That does not fall under the purpose of a commissioner. Because setting insurance rates, that's what insurance companies do. They're the ones setting their rates. But the commissioner does the rest of these. Okay. Question 50. Which of the following qualified plans would a public school teacher have? Yes, a 403B or a tax sheltered account would only make sense for a public school teacher. The rest of these are not qualified plans, but a 403B is. Or like I said, you'll see it with tax sheltered. So basically just a retirement account. Good job. 51, a MEC is a what? Yes, it's taxed as an annuity, more tax than life insurance. So like we said, it's a modified endowment contract. If you pay too much, they're going to transform it to an annuity instead of a life insurance policy. So a MEC, modified endowed contract. Question 52. All of the following are true in regards to tax deductible, except, yes, tax are deferred to a later date. That is not true. You will be paying your taxes, or you are, like I said, regarding true to tax deductible, you may not pay taxes on these, which is typically for businesses. They get out of paying taxes a lot. Or you may lower your tax liability, or you can write these taxes off. But as far as deferring them to a later date, no. You got to pay them taxes.
Bailey said 2 things are true: taxes and death. And we deal with both. Yes, ma'am. That is so true.
That's true.
Can avoid either one.
Okay. Question 53. How many days must a rollover be deposited to another account? 60 days. They give you just enough time to roll over your deposit to another account. So they'll give you a couple months. Get yourself together. So 60 days. All right,
30 more questions for me to catch up to Bailey.
In a rollover, a trustee is required to hold what percentage to cover taxes due?
Okay, to guess on this one. And it wasn't that educated.
So 20%. So usually when you start taking money out of an account, you will get charged a 10% penalty. But most of the time, trustees, they'll take an extra percentage just in case it may be more than what you thought when paying those taxes. So just think about doubling that 10%.
Oh, that's right. And that was on the last, we had a question about that already. See, that's another one, baby. Like they'll get you like that. We already answered that question.
Yes. Like I said, just double that 10% just in case it's a little bit more than what you thought with your taxes. All All right, question 55. What is the frequency at which the commissioner can examine an insurer's records? Yes, as often as the commissioner considers appropriate. So anytime an insurer or insurance company can have their records examined, they got to keep an eye on these insurance companies because they can easily be doing something with people's money. So they can do it as often as they consider appropriate. All right. Question 56. Which statement is false regarding testimonials in insurance advertising? Yes, may contain premiums or policy provision information. So this is false. When advertising for insurance, we never want to contain the premium amount because we don't want to guarantee someone what they may pay and that may not be what they end up paying. Or policy provision information, because these can change depending on the person, their age or their health. So we don't want to include that when we're advertising because that may not be what that person ends up paying.
Real quick, too, from the previous question about the commissioner and checking in on the insurance companies, Betty was saying that she's almost put 5. But she was thinking that's keeping records, not the exams themselves. But the keeping records is 3 years. Am I remembering that correct?
Okay. I was about to say, I think that's 3.
Yeah. So the insurance companies, they do have to keep their records for 3 years, right? Before they can, destroy them or what have you, just in case there is an audit, or an examination done by the commissioner. So it's 3 years for keeping records. Yeah. You have to keep them for at least 3 years.
All right, question 57. Who or what qualifies a plan? The IRS, so the government will qualify a plan. So they're at the very top, making sure that these insurance companies are doing what they're supposed to do when they're giving people these policies. So the IRS, Internal Revenue Service, is qualifying the plan. That one's a little tricky.
Yep. And also those plans that they qualify are like the retirement plans.
Yeah.
Like the state doesn't have their hand in that, the government does. So
yeah, the government, yep. All right, which of the following is true for a traditional IRA?
Oh God.
Tax deferred. So a traditional individual retirement account, you're just putting that money in there pre-tax. You're not paying any taxes on it right now. So you're deferring those taxes that you're putting into the account. So as you retire, once you start taking that money out, now you'll be taxed on it. So a traditional individual retirement account, you're just deferring or putting away your taxes for now. Yeah, those tax questions are hard.
Yeah.
Question 59. When can you take tax-free distribution on a Roth IRA? Yes, usually after age 59 and a half. Other than that, most of the time you'll be charged some type of tax penalty. But in order for it to be tax-free, you have to be after age 59 and a half. All right, question 60. Distributions before 59 and a half are allowed without penalty for all of these except unemployment. So of course, if a major medical event happens, they'll let you take out the money. If you're trying to fund college or education, they'll let you take it out. If you have some type of disability, but they will not let you take it out necessarily without a penalty if you're unemployed, because they see it as you can go get another job to make some money. So
like, why did I answer something that's so stupid? Lord.
Yes, unemployment.
Ooh, Bailey is whooping them.
I know.
Yes, Lord. Thank you, Jesus. I already got my license. I got to take this test. I wouldn't give them.
Ooh, Lord. That's too much. Question 61. The 7-pay test on the MEC is checking for.
We talked about this one.
Overfunding the policy. So with the 7-pay test, they're trying to make sure you're not putting more into the policy than what you should be. So it's not necessarily making less than 7 payments or making more than 7 payments. It's just about overfunding it. So that way you're not trying to cash out on too much on that policy. So overfunding.
This is how I know I need my coffee, because I explained this. How about that? I explained this and then answered the question wrong. So y'all need some coffee. Bam.
No. Question 62. Which of the following creates a taxable event? Yes, the interest on a death benefit. And like we discussed earlier, anytime you get that interest or that extra money, they're going to try to tax it. So that interest will create a taxable event. Right, we only got a few more. 63, which is true in regards to a cash surrender. Excess over the premium is taxable. So you're paying more into that policy than you should be. That excess, paying extra premiums when you shouldn't be, just to accumulate more money into the policy. So that excess is going to be taxable. You got to surrender that money. They want it back. All right, 2 more questions. 64. Qualified plan benefits are set up to benefit, yes, the individuals and employees. And this question, don't get tripped up with the IRS. They're the ones that's qualifying the plan, but who are they qualifying it for? The individuals are the people, employees that are getting these plans. So yes, they are set up for individuals and employees. All right, last question. In the event of an accelerated death benefit, what happens? It's received tax-free. Because they're hurrying up and giving you those benefits of that death benefit, they're going to go ahead and give it to you tax-free. And most of the people that receive accelerated death benefits are people that have critical illnesses. And so they're about to die soon. So they're just going to go ahead and give them those benefits tax-free. As a gift, I guess. All right. That ends our Life and Health General Quiz 1. Kahoot. And the winner is Bailey again.
Good job, Bailey. Good job. And I seriously tried to beat you. I promise you I tried to beat you this time. I tried hard, okay? This old brain ain't working without my outfit.
Good job, everybody.
Yes.